A firm's details are as under: sales variable cost, fixed cost is given to us. We've been told that the firm has borrowed some money and they want us to calculate leverages, return on investment, and the impact on EBIT if sales was to increase by 6 lakhs. We'll go ahead and make our full format first. This time around we have been given no data in terms of, actually we have data in terms of per unit, so we'll maintain a per unit column. We have particulars, rupees per unit, and amount in terms of rupees. And this is going to be quite a long format going all the way down to EPS. It's advisable for students to use full forms. In this sum, I'm going to use short forms to make it quicker. It is not advisable to use these short forms in the exam. We start with sales. From sales, we subtract variable cost to get contribution. From contribution, we subtract fixed cost to get ourselves EBIT, earnings before interest and tax. From that, we subtract interest to get ourselves earnings before tax. From this, we subtract tax to get ourselves earnings after tax, which we can also call net profit after tax. From this, we subtract preference dividend in order to get what we call earnings available to equity shareholders. From there, we divide number of shares to get EPS. Now that we have the format in place, it becomes easy for us to substitute the values and calculate our leverages. Now, starting from the top, we've been told we are dealing with, and of course, the 100 rupees per unit for units is here. What they mentioned over here is the face value of an equity share. Keep that in mind. Now, sales is 100 rupees per unit. We know that variable cost is 50%. Okay, so I'm going to go strictly down the line. Sales is 100 rupees per unit. I know the sales amount is 24 lakhs. So 24 lakhs. Now, if I was to divide 24 lakhs in 100, I will know that the units involved is 24,000. So 24,000 units. Then 50% of 100 gives me 50, 50% of 24 lakhs gives me 12 lakhs. Going forward, I know that my fixed cost is 10 lakhs. And the difference between 24 and 12 is 12. 12 lakhs minus 10 lakhs, get 2 lakhs. Then going forward, interest is going to be based on our borrowing. We've been told that the borrowing is 10 lakhs at 10% per annum. Multiplying, we'll get ourselves 1 lakh. 2 lakhs minus 1 lakh is 1 lakh. Let's see if we've been given any information about tax. And throughout the sum, no tax is mentioned. Tax is going to be 0. We get ourselves earnings after tax, which is 1 lakh. The next thing we need to look at is preference dividend, and that can only exist if we have preference shares. There are no preference shares in this question, and we are going to end up with an answer of earnings available 1 lakh. The next, we need to calculate number of shares. Now keep in mind, number of shares is equal to equity share capital upon face value. Equity share capital is 10 lakhs. Face value is 100. We are going to get number of shares as 10,000. 1 lakh upon 10,000 gives us 10. Earnings per share is 10. Now that we are done with this format, we are in a position to solve for leverages. Remember the degree of operating leverage, and let's just do it parallel to the table. Again, I'm using short forms. It will be best if students follow full forms. Degree of operating leverage is equal to contribution upon earnings before interest and tax. Contribution is 12 lakhs. Earnings before interest and tax is 2 lakhs. That means our degree of operating leverage is 6 times. Next, we have degree of financial leverage. Degree of financial leverage is EBIT, which is 2 lakhs, upon EBT, which is 1 lakh. So we are going to get an answer for DFL as 2 times. And yes, writing the formula is important. So before I substituted, I should have mentioned that DFL is equal to EBIT upon EBT. Next, we have degree of combined leverage. Degree of combined leverage is equal to contribution upon EBT. The contribution is 12 lakhs. The EBT is 1 lakh. So I'm going to get an answer of 12 times, which I know is correct because I know that DCL is equal to DOL into DFL, which is 6 into 2. 6 into 2, which gives me 12 times. Therefore, DCL is equal to 12 times. But the sum isn't over. We still have to factor in, if sales increases by 6 lakhs, what will be the new EBIT? Now, there are a few ways you can calculate this. One is by making use of a formula. We know that the degree of operating leverage is also equal to percentage change in EBIT upon percentage change in sales. And now let's see, they're telling us that the sales increases by 6 lakhs. Currently the sales is 24 lakhs. The percentage change in sales is equal to 6 lakhs upon 24 lakhs into 100, which should give you 25%. I know that my DOL is 6. I do not know my percentage change in EBIT, but I know my percentage change in sales is 25. Simplifying this, I know that the percentage change in EBIT is going to be 150%. The current EBIT is 2 lakhs. So the change in EBIT and change in EBIT is equal to 2 lakhs into 150%, which gives me 3 lakhs. So I know that the change in EBIT will be 3 lakhs if sales increases by 6 lakhs. The new EBIT will be 2 lakhs plus 3 lakhs, which gives me 5 lakhs.